Welcome to Revere Asset Management's Your Money with Danny Stewart
The market will always overshoot to the downside and to the upside.
and Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Happy New Year! Happy 2025 from the Revere family. And speaking of the Revere family, if you were a Revere client in 2024, did you get rubbed the wrong way by the Revere management team? Did we rub you the wrong way? Let me explain. Folks, my beautiful, hot, lovely wife, Alice Catherine, a.k.a. AK, she goes by AK, AK and I make this dry rub we make for meats and vegetables and whatever every year. And we send it out to the holidays to all of our clients, Christmas, Hanukkah, whatever. And we send them out. Well, 2 years ago, we had a little issue and they were too fat to fit through the mailbag, and we got a bunch returned. And so it was a little bit of a snafu. So this last year, and we have quite a few more clients, so I wanted to make sure we didn't have any snafus. I took about 10 samples to the post office, and I asked a bunch of questions. Why did it happen? And apparently they've got this about an inch sleeve that you got to be able to slip the letter through for the automatic things for it to go. And some of my samples were a little bit too fat. Anyway, so I took these samples in, and of the 10 samples, 8 of them went through right away, no problem. One kind of got a little caught, but one didn't quite go through. Well, my mistake was I already made hundreds of these packets. And so I thought, you know what, I'm going to have to take a chance now because I can't go through all of them to see which, 12 are too fat. So now next year I'm going to handle it a little more professionally. I'll probably just have someone do it for me. But anyway, so I sent these out hoping that they would all go to you, our valued clients. And most of them did. However, we got a few returned, but worse, so you don't even know if you got it or not. But worse, we had a few that actually got a notice to the post office, hey, you got a package down here. Please bring an extra $2.12 extra postage to get your dry rub. So if that happened to you, please reach out to me. I'm sorry, I will make you whole. And that was not our intention. However, to make it up for you, Revere crushed it last year for clients, and clients are ecstatic. If you were fully assimilated at the beginning of the year last year in our flagship portfolio, Grotection, you actually essentially, I'm rounding, you essentially beat the S&P. Very, very, very few, or matched it. Very, very few advisors did that last year. Because they have the pie charts of us portfolio. They got a little bit of bonds, dividends, international emerging markets. They've got a little bit of everything. Rather than focusing on the strongest sectors and trying to stay away from, which was pretty much only the S&P last year, and stay away from the other sectors. But in any event, we did extremely well, and our clients are ecstatic. And then now we're rolling out a new portfolio for sophisticated investors. You got to be sophisticated or accredited, which means accredited means you're $1 million net worth, exclusive your home and car, or you can be fairly savvy and understand it. And that's the TurboTaction, which is to achieve more alpha. That portfolio crushed the S&P last year, beat it handily. If you want more information about that, you can reach out to me, but you got to be accredited or sophisticated at least. You got to understand market. We're not going to just put a retail client in there that, only has a couple $100,000 and doesn't understand. Now, with that said, I will tell you, these guys, young, strong, they follow the Grotection rules. So if they miss a sale, Don's going to sell it for them anyway, but their drawdowns have been less than the S&P. So I'm supposed to tell you that it's very more aggressive because we've got a lot of active trades going in there, but our drawdowns are less. So anyway, I manage risk by drawdowns, by the way, not by variance or standard deviation, any of those hoodly doodly things. I want to know how much my net worth went down. That's how I measure risk. I keep it simple. Anyway, so we really hit it last year, and we had a very good year last year, and my hat's off and kudos to the team. Now, last year, here's the question I got to ask you folks. Last year, we didn't really need the protection part of Grotection. We didn't need the protect. A few little times we had to get defensive. but you didn't need the big protection last year because it was pretty much primary uptrend with a little bit of choppiness in the middle, right? However, Protection made that 25% last year with sell rules, with defense. So if you did need it, it was there. For instance, in the COVID variant, did you get slaughtered? We didn't. We barely breached double digit. Market went down 35%. Inflation, 2022 bear. We barely breached double digit. Market went down 28.5%. Hell, bonds were down 30. It's a much smoother ride. In any event, I've got a couple articles, just 2 articles this time in the show notes. And I didn't do the mailbag this week, folks. I had one guy that was talking about some, some investment, advisors you got to watch out and be careful. I agree with that. But most of our mailbag, I had 30, 40 mailbag from clients just saying, kudos, thank you very much, did great. Had a few more colorful ones. You guys kicked last year, thanks. I mean, had all kinds of stuff. So I'm not going to go through that. But the 2 articles I do have in the show notes because it's for you and it's about your money, not their money. Wall Street thinks it's their money. Advisors caution as alternatives go mainstream. This is important. And I mentioned this already over a year ago. And now they're just starting to warn about it, okay? Remember I told you the ETFs, they're starting to monetize everything and put everything in these ETFs and commoditize everything. So alternatives, alternative investments are usually for accredited investors, and they're usually got lockup periods and they're illiquid. Well, now we're going to take risky, illiquid assets and we're going to stick them in highly liquid ETFs. So when you have a liquidity crisis and when it hits the fan and those become illiquid in these supposedly liquid ETFs, what could go wrong there? Doesn't take a rocket scientist, folks. If you're buying alt ETFs, you better know what the hell you're buying. Just saying. And here is my personal favorite and the topic du jour of our show and our strategy going forward. It's always our strategy, folks, because it's evergreen. Protection is an evergreen strategy for all seasons. So this is the headline of this article. I love it. Buffer ETFs versus annuities. Which is better for retirement income? Answer, neither. Well, I mean, if 5 or 4 or 5%, 6% is enough for you, then that's fine, do it. Then you don't need Revere. 5 or 6% is enough. Go do an index annuity, be done with it. You don't have any fluctuation, you'll be fine. But if that's not enough, then you may. Now, why is that? Because capping the upside on these products, right, has the inverse reaction, negative reaction of their story about capping the downside. Remember, they can't lose money. They can't go below 0. So in a down year, you can't lose money. But for that trade-off, you can't go above 10% or 12% or whatever the cap is, or they do monthly averaging. Whatever they do, they're mathematically made to pay you about 5, 6%, 7% at the outside if you time it right. Because remember, they have a time period where they do the rebalancing or the rollover to the next product. So on some arbitrary date, semi-annual or annually, one time a year, you get to make your adjustment. Guess what? At Revere, we make adjustments necessary 365 days a year. We make asset allocation adjustments as needed in real time. We don't wait for 6 months if the market's crashing. That's why that doesn't work. But in any event, so we may have a 10 or 12% downside potential, been historically, going back, but you don't have the upside cap, so you don't have that 7%. So last year you got the 25. You didn't get the 12. Okay? That capping the upside brings your return way down. You must understand that. Okay? So we want to folks, we're not capping. So with Revere, we're making long-term returns, low double digit, 11, 12, 13% long-term on our conservative money. That's protection. Drawdowns much less than the S&P. And now we've got turbotection that's going to make higher alpha in our opinion. It has. Short time period, hadn't been around that long. That's why we don't have a lot of tracking. That's why it's got to be sophisticated. Now, these guys keep doing what they're doing. for a couple more years and I've got a little bit more time frame, we'll open it up to everybody. Then everybody can have what's in my money. Your money can be my money. That's the other thing about Revere, folks. The guy at CNBC says, you don't know, this stock's the greatest thing since sliced bread. I don't own it. My wife doesn't own it. Our company doesn't own it, but you should. Why is that? It's because the investment banking side of his firm is the actual client. They're raising $100 million for a stock or a bond deal. He calls his buddy over on the retail investment side, say, hey, go tout it on CNBC. We're trying to close a deal. That happens a lot. There's conflicts of interest. When I tout a stock, I own it. If I buy 3.5% for you, I buy 3.5% for me at the exact same timestamp and price. Our money, Don and my's money, looks just like your money. By the way, that's the name of this podcast, Your Money. Because it's your money, not Wall Street's money. So with that, I want to go to the team and find out about your money, meaning Revere clients' money, my money, Don's money, and what we're looking at and what the markets are telling us in real time, because price is truth. And we're not going to wait till the end of the year to do some arbitrary balance just because it's December 31st. I may have had to rebalance in November. Anyway, Don?
Yeah, Dan, one of the keys for the year-end client video that we sent out was just reinforcing the difference between what we do at Revere versus the traditional pie chart asset allocation. And all of the presentations that we're going to do as part of this podcast today are going to tie directly to one of these key metrics that we track, where identifying what we do versus what they don't do. You know, Dan mentioned the annual return. We're more focused on market cycles. The market cycle actually started in early November 2023. The reason that the investment community focuses on annual returns is because they think that you're going to be in a pie chart that's all in. So it's a simple comparison year to year. Beginning of the year to the end of the year. If you're with Revere, we really are more focused on the beginning of the cycle to the end of the cycle, and our returns were between 40 and 45% if you go back to the beginning of the cycle back in early November 2023, and that's just one of the ways that we're different from the typical advisor. Let's step back and say, where are we right now? The S&P 500, December, according to seasonality, is supposed to be one of the best months of the year. Does that mean that we're just going to sit back and kick our feet up on our desk and assume that the market is going to go up in December? No, because it absolutely didn't, because on December 18th, the Fed came out with a very hawkish outlook on interest rates, and the market reacted accordingly. Over the past month, there's been a lot of chopping around. We reduced our exposure, but we didn't go to zero. We don't want to overreact. We don't want to throw the baby out with the bathwater. And a highlight of the nightly videos that we put out is that the reinforcement of how leading stocks were actually acting better than the index. So now the delegates have been confirmed. We're 3 days away from the inauguration, and the market is battling back near the 6,000 level as of 11:15 Eastern time on Friday. So what we saw was a shakeout below, and again, we reinforce this in our videos every night. The market never gets into serious trouble unless you break below this black line. That's the 200-day moving average. And our portfolios are going to vary. If we're above the red line, we want to be maximally aggressive. If we're below the black line, we're going to be at a maximum defensive position. But what we did right now is something very typical, and that's a pullback to the 20-week. This is the green line. In the middle of the year, we undercut it. This was the panic over the yen carry trade. And we touched this level several times. We barely broke beneath it in December before we recaptured it now. We dictate our view on the market down to a number. It's called RVAB, Revere Volatility Adjusted Beta. It's how much exposure we have to the market across all of our positions as opposed to a pie chart, which stays the same regardless of what's going on. Dan, when we were pre-talking to the show, he said it's like you're always dressed for winter in the summertime, or you're always dressed for summer in the wintertime.
No. I said you could wear. That's like saying you could wear a parka snow skiing or at the beach, or you could wear a bikini snow skiing or at the beach. Yeah, I want to wear a bikini snow skiing.
Sense.
Yep.
Yeah, they're dressed the same portfolio, regardless of what's going on in the market. That's absolutely ridiculous.
That's how you get burned, Don. That's how you get burned badly, and then you get frozen out. Yep.
We've got 4 technicians on staff here. We're talking constantly, and today we broke through this downtrend line.
And 2 outside consultants that review our work for accuracy. Anyway, go ahead.
And we broke above this downtrend line today, and we've been adding exposure off of the lows on a recapture of the moving averages, but we've held on to our core individual positions because, as I said, leading stocks, and this is kind of an anomaly, and this is, again, we want to skate to where the puck is going, not to what we think it should be happening. But breaking above the downtrend line and sticking with the leading stocks, we're not panic buying today because the market is having a good day. We stuck with the positions, sold out, didn't sell out because our stops weren't hit. It's that simple. Removing emotion out of it and going with a fact-based approach. And with that, I'm going to start tossing it over.
Yeah, Don, real quick. Go back to that previous chart. I want to show the listeners how with the moving average stack, I want to show how the moving averages were all stacked perfectly in order. The one you had before that, you had a chart that showed the line. I think it was a time frame. This
is the weekly.
Yeah, that's the weekly, folks. Look, you've got the 200-day. They're all stacked in order as they should be. That's pretty much in order. All right, and when the 21 hooks above the 50, that's really going to be even more bullish short term. But that's how and no matter whether you feel scared, like I'm scared. I'm scared right now to be fully invested. If you're not scared, you don't understand the deal. The rules are so we can overcome our fear. And by the way, those indexed annuities they're selling you that's going to make you 6%, they're selling fear. They're telling you can get most of the S&P gains, but none of the losses. The problem is it's a lie. You're not going to get most of the gains. You're going to get 7, 8, 6%, 7%. So go ahead, Don. Sorry.
All right, so back to the comparison of Revere versus other advisors. Obviously the investment approach, we're trend following their pie charts, direct access to us. We've heard so many times from people that are interviewing different managers or have their money somewhere else. They complain about the returns, and the pie chart guy says, "Oh yeah, well this guy had a bad year. Let's pick this other fund," and he suffered from style drift and a million excuses. In other words, they're blaming it on the outside portfolio manager, not on the allocation that they have.
After
With us,
the
you're
fact.
talking
After
to the
the
people.
fact. Yes, after
Right,
the fact.
after the fact. With
Not
us,
real.
you're talking to the people that are making the decisions. Active decisions, technical analysis of the market, focus on the leading stocks, avoiding lagging sectors. This is a huge one. We've rarely owned bonds over the past few years, and because they've been lagging. No emerging markets, they've been lagging. No international exposure, they've been lagging. Why would you? I say it all the time. It's like going to the store and buying rotten vegetables to say you maintain a balanced diet. It makes zero sense. No diversification here at Revere. Nightly videos, quantified downside risk. A new stat that Ted's going to talk about here, something we've been discussing internally, but something that you will never hear a pie chart allocation person talk about, is the MAR ratio, MAR. And what it is a compounded annual growth rate divided by maximum drawdown. If you have a 1, you're a superstar, and that's about where we are at Revere. If you have a pie chart and you suffered through the 30% drawdown during COVID, or the 50% drawdowns during the bursting of the tech bubble in 2000, or the financial crisis, a 50% drawdown, an 8% annual return divided by a 50% drawdown is a horrific MAR ratio. And Ted, I'm going to turn it over to you now. You've got this chart here. Take it away.
Yep. So just a quick, simple presentation on the MAR ratio. We're not going to get too in depth on it. Actually, it's a pretty simple ratio, which is actually what we like in house. Want to keep things simple. Dan mentioned earlier how there's the Sharps ratio, adjusted Sortino ratio, and the Sharps talks about like factors in standard deviation, and the adjusted Sortino doesn't punish for the downside standard deviation and it rewards for the upside. We're just going to keep it simple because Dan is really right. It's about how much your net worth or my net worth has drawn down at a specific given time. And the MAR ratio is the money adjusted return ratio, and it's your compounded annual growth rate divided by the largest drawdown in the time frame of the time frame of when that CAGR is calculated. So I just gave a example on the screen. I had 5 examples, and you can say either it's different individual investors, different funds, different mutual funds. It doesn't matter. And I did it over a 10-year time frame, and that's their compound annual growth rate on that first line. So as you look across without factoring the drawdown, obviously you're going to go towards this 25% compounded annual growth rate. It's the highest, right? So why not achieve the highest return? But just looking at the return doesn't account for risk at all. And the next line, DD, stands for drawdown. I have the drawdowns for each portfolio or fund across the screen. When we look at the first one, it saw 6% compound annual growth rate over 10 years and had the largest drawdown was 10%. So that comes to MAR of 0.6. So that gives you an idea of how the math is calculated. And once we do the calculation for the MAR ratio across all these portfolios, we have that at the last line. And now when you look at the results, the best risk-adjusted return portfolio is actually the fourth one with an MAR ratio of 1.2. And to give some context, at least theoretically, academically, anything above a 0.5 is quote unquote good. Anything above a 1 is exceptional and extremely impressive. And so that fourth portfolio definitely is a standout. While almost all the other portfolios are doing decent, the one doing 12% for 10 years with a 25% drawdown is definitely subpar compared to the other portfolios. And the MAR ratio, like Don and Dan talked about, it gives you an idea of how much return per unit of risk you're taking on. And of course, you want to maximize the MAR ratio.
All right, Ted, that was awesome. No, that was awesome. And folks, here's a question you have to ask yourself, because Ted's right. If you just keep it real simple, don't get into the statistics or the math, but look at that 25% return that everybody that just looks at total return, they go, ooh, I want that one. But if you're going to lose 40%, and remember, you're going to lose 40% in 3 weeks or a month, are you going to soil your pants? Are you going to stay the course? You got to ask yourself that. That's really why that 18, because people can normally stomach 15%. I mean, it's really uncomfortable, but they don't go uncle and pull the ripcord. And that 18%, it's a smoother, it's an easier return, and it also compounds better. You also have the sequence of returns. That's why it's a big deal. All right, Don.
Yeah, the sequence of returns is absolutely a big deal. The worst, if you're that is the sequence of returns is what do you get on an annual basis over a select period of time. So if you're headed into retirement, you want to have a very positive sequence of returns. If you're headed into retirement, a big negative sequence of returns will kill your nest egg.
Cut it in half. Literally cut it in half. Yes.
It can. Yeah. So you get a negative 40% right before you thought you were going to retire with $1 million, and all of a sudden you get a 40% drawdown. You're bagging groceries at the store or looking for a consulting gig.
You're a Walmart greeter. Yeah, don't be a Walmart greeter.
Yeah. All right. So that goes to ratios. Next up is Todd, and he's going to focus on a leading sector. This is another thing that we do that the typical pie chart advisor doesn't do, because they don't think that you can time the market. So again, they're dressed the same regardless of the weather. We're going to focus on, Todd's going to talk about Taiwan Semiconductor and the impact on the semiconductor Index, as they just reported earnings recently. He dug into the report. Take it away, Todd.
All right. Taiwan Semiconductor reported earnings for their fourth quarter of fiscal 24 yesterday morning. And why is Taiwan Semiconductors an important stock to look at? Whether we're buying it or not, it's a company that we really want to focus on and analyze the data that comes out of their quarters. For the fourth quarter, let me go back and just say that Taiwan Semiconductor is important because they manufacture approximately 62 to 65% of global semiconductors. So they are by far the largest, most technologically advanced semiconductor manufacturer in the world. Okay, so when they report, we want to listen to what they have to say. So just a quick summary of how they reported. They had sales of 26.9 billion versus 26.3 billion estimates. That was a 30% year-over-year increase. Their earnings came out at $2.24, looking for $2.20, and that was about a 47% increase and a 14.3% sequential increase. Their gross margins came out at 59%, which was 1.2% higher. And all of this was driven by strong demand for their 3 and 5 nanometer chips. So 50% of their revenues are based on their 3 and 5 nanometer technology, which is the most advanced technology in the world, and they're the best and they're the leaders in the smallest semiconductor chips. We also look at their guidance. How is their guidance looking for the first quarter? And for the first quarter of fiscal 25, they're anticipating 25.4 billion when estimates were 24.4 billion. So that's a $1 billion up guide in revenues, which is a 38% increase year over year. And they're anticipating sales to increase about 53 to 55%. So this is pretty massive because as CanSlim investors, we're looking for 25% increases. They're well ahead of it. And this is a $1 trillion company market cap wise. The other major thing we're looking at in this quarter is how is their CapEx forecasts coming out? And they dropped a very good news on the CapEx front. They're looking at 40 billion in spend for CapEx. CapEx is the equipment that they're looking to add on and build. They're building new factories in the US, Germany, and several other countries right now. So this 40 billion was 5 billion ahead of estimates, which is also a very encouraging sign. And that's very good news for some of the semi-equipment manufacturers like ASM Lithography, KLA-Tencor, for example. And this 40 billion compares to about 29.8 billion for last year. Also, another keynote, their CEO said that he anticipates revenues from AI accelerators, to grow at a compound annual growth rate of 40% over the next 5 years. That's pretty huge. AI accelerators are really what that boils down to. This is what companies like NVIDIA are what Taiwan is producing for NVIDIA. And of the companies we own, this is very good news for Marvell Technologies, Broadcom, as well as Credo, which is another company we own that is breaking out today. So we like to look at these numbers to kind of get a read through of how the key stocks that we're invested in for our clients, how this upcoming quarter may look. And we already know that Marvell and Avago and Credo all beat and exceeded estimates last quarter. And now we're getting further confirmation from Taiwan Semiconductor that we're running ahead of expectations going into the first quarter. So that is a positive for us, and we'll continue to monitor this group and our holdings in this area. And we're leaning positive going into earnings based on this information.
Yeah, great stuff, Todd. It's not just what they did, it's how it trickles through the entire industry. They are one of the bellwethers, because if they're not spending money, that means that the demand from their customers isn't there to prop them up. And this report was huge. It really changed the tenor of the overall chart for the broad semiconductor index. Here's the SOX. This doesn't look as good as the SMH because they don't include Taiwan Semi in there, but this is a better chart, and finally shown some relative strength over the last couple of months as they had a weak time. The broad overall semiconductors in the late third, early fourth quarter of last year. Great stuff there. Now, Connor's going to talk to you about another topic where we're different from the average advisor, and that's how to handle markets that go sideways. They're going to do the average advisor is going to be the same whether we're going up, going down, or going sideways. But we show every night at Revere in our videos how we're adapting to the current environment, and Connor's going to talk about choppy markets. Take it away, Connor.
Yep. Yeah. Basically, I wanted to start kind of what Don just said. The market state, it's not a one size fits all. It's a dynamic that's constantly changing. And if you're just going to use a one size fits all, that's not the way to approach it, because it's always changing. And, some markets you're going to be going for the home runs, and then other markets you're going to be going for the singles and doubles. And that's primarily what happens in a choppy market. So there's a couple of things that we do to recognize what type of market we're in. So first of all, we have the videos every night. You see the trend gauge. So we have three things there. First is the market leaders, and that's going to tell us the leading stocks typically lead the indexes. So how they're acting gives us a good tell. And then second is the trend of the indexes on a short, medium, and long-term trend. And that's with our 21, 50, and 200 day. And kind of what I want to talk about today, which ties into market leaders, is what I call the length and quality of the watch list. So every night we scan stocks, we make a watch list, we're prepared going into the day. And you'll tend to notice that in a good market, you're going to have a very large watch list. So you're going to have a tough time narrowing down stocks into like a focus list that you want to act on in that given day, versus in a choppy, weak market. It feels like you're searching for stocks to put on your watch list, and they could be B to B minus setups versus what I would consider like an A plus setup. And so if you have a like smaller watch list, the next iteration is, what are the stocks doing on your watch list? And you don't even have to buy them. You can just watch them for feedback. And what I like to do is, if the market's choppy, you want to know if the market is rewarding buying strength, or is it a type of market where you buy weakness, sell the upper end of the range. And basically, I just like to go through my watch list every night and look at breakouts that we're setting up and see if they followed through. So a few examples from this week that I wanted to talk about is, first, you have SMTC. This one broke out 2 days ago, and yesterday it came back into the pivot. So, very normal action. And then look, today it's falling through to the upside. So I would review this stock and classify this as a successful breakout. So far, it hasn't leaked off, but it has good volume. It never really broke through the pivot, and you're seeing that expansion today. Another one is Robinhood, and this one is in theme as well. Obviously, we have an administration coming in that's pro crypto, and you're kind of seeing the market, and Robinhood is showing even more strength. It broke out and never even came and retested the top of the base with volume supporting. So that's another check. And the action there tells me that, and it goes in for specific sectors as well, is that the market's rewarding buying strength in the crypto sector as well. Some other names, GEV. This is one that broke out a couple days ago, but it's not giving anything back. It's falling through to the upside. And again, we're seeing a dynamic in the market where money continues to flow into these alternative energy power generation names. And you can just look at GEV, the leader, which is showing immense RS, continues to make new highs each day. and a lot of stocks in the sector are following it. And then a different sector perspective is, where else is the money flowing? Well, one holding in Grotection specifically is EQT, and this is a name in the natural gas oil industry group. And this broke out when the market was correcting, and you can see it continues to ride higher. And one thing you'll tend to notice is that when institutions rotate into a new sector, if you have a good eye, it's pretty obvious. And to me, it looks obvious that people are putting money into these type of names because you can look at other names in the group. LNG is another one. This one's seeing huge volume and breaking out very strongly. And that's just another tell that money is flowing into this sector because, when you're an institution, these guys tend to take a shotgun approach. So, they see 5 names in the natural gas industry group. They're probably going to go at all of them and then, add to the winners and cut the losers. And that volume and price action will alert you ahead of time. So I would rank these recent breakouts as pretty positive. I would say that's a shift in the market dynamic than what we've seen in the last couple of days. And that also coincides with the indexes getting back above medium and short-term moving averages, which is another green light that we look for when analyzing the market. And I think just the main key is know what environment you are in. Some environments you're going to get rewarded for holding something as long as you can and not being so quick to take profits. And then in other markets, if you don't take profits, you're going to get stopped out rather quick. And it's an art, not a science. So, you see our tools that we use. They work pretty well. They work for us. And again, it's always changing. So, but these are some tools that we use to have a better idea on how, our trade ideas, our horizon, our expectations, and all that stuff. And it's nothing like a pie charts RS that whenever you come on board as a client, it's just boom, you're allocated, and now the manager just goes and sits on the golf course all day.
Yeah.
Great. Great stuff, Connor.
Stealing my line, Connor. I love it.
Yeah, I know.
All right, guys. Don, you got anything else? Are you good?
No, that's it. We're good. Take it away, Dan.
Folks, if you're an investor, you need to know what the MAR ratio is. So you don't have to be a Walmart greeter because you got a Pie Charts or Us portfolio from a Bikinis or Us advisor. Okay? Learn a better way. Learn how professionals do it. Okay? So is your advisor asking you for a tea time, or are they looking at market levels? And speaking of market levels, IBD has been Don has asked, IBD Live has asked Don again. He's coming back on to IBD. That's a paid subscription. That's kind of, got to have a subscription for it. But if you do, it's a lot of active traders are on there. But Don is going to be a guest on IBD Live Friday, January 31st. Right, Don?
Right. 2 weeks from today.
2 weeks from today. All right. Oh, well, we're going to have to work around that on the show then. I guess that kind of interferes. Doesn't IBD Live know that we do this podcast every Friday? No, I'm teasing. All right, folks, listen. If you like what you heard, please tell a friend, tell a neighbor. Just send them to revereasset.com. Up in the right-hand corner, there's a subscribe button. Just put your name and email address in there, and you'll get our daily market insight video every evening the market is open. Folks, we tell you what the markets are doing, price is truth, and what we're doing in the portfolios. Every evening the market is open. We're not only the most transparent advisor in the country, we're the most transparent advisor in the world that I'm aware of. Then next to it, there's a contact us button. You can shoot me an email, ask me for a complimentary portfolio review so we can fix your pie chart. And you can always call us old school at 855-REAL-WEALTH. And we got a YouTube channel, Revere Asset. Just type in Revere Asset and hit subscribe. We'll talk to you next week, folks, on your money. Not their money, your money.
So it's not how much you make in the market, it's how much you can keep.